Your money-making broadcast starts now. Markets closed today on a mixed note as Canadian and American investors digested the most anticipated earnings release of the year. The S&P 500 slipped a fraction to close at 741, while the Dow Jones Industrial Average posted a solid gain, crossing above the 500 mark. The tech-heavy Nasdaq edged lower by 0.2%, and small caps as measured by the Russell 2000 lost a full percentage point. But the story that dominated every conversation today, nvidia's quarterly results, did not disappoint. Here is your market recap for May 20th, this evening on Wall Street. This evening's biggest story is nvidia's earnings, and the numbers were nothing short of extraordinary. The company beat revenue expectations by a wide margin, raised guidance across every major segment, and added a staggering $80 billion to its existing share buyback program. nvidia's stock actually fell more than 5% during regular trading, that is classic positioning and hedging ahead of a binary event. But the real story unfolded after the closing bell. In after-hours action, the stock surged as investors absorbed the sheer scale of artificial intelligence demand that nvidia's results revealed. For Canadian investors, the implications are deeply significant because the AI build-out is not just an American story. It is a global infrastructure megatrend. Companies like AMD, Broadcom, and Micron all stand to benefit from sustained AI infrastructure spending that shows no signs of slowing. Cisco Systems, the networking giant, is another indirect beneficiary that is often overlooked. AI data centers need massive networking upgrades, higher bandwidth, lower latency, more capacity, and Cisco is exceptionally well positioned to capture that wave of demand. The father of value investing, Benjamin Graham, would point to Cisco as exactly the kind of company he favored: a strong balance sheet, a dominant market position, and a reasonable valuation. That combination of quality and price is rare in today's market. Moving to macro news, Kevin Warsh officially takes office as Federal Reserve Chair this Friday, marking a significant transition for monetary policy. The timing could not be more consequential. On one side of the debate, Treasury Secretary Bessent is pushing a disinflation narrative, arguing that price pressures are cooling steadily and the Fed can afford to hold rates steady through the transition. On the other side, veteran economist Ed Yardeni is making headlines with a call for a July rate hike, warning that services inflation remains stubbornly elevated and could force the Fed's hand sooner than the market expects. This division between doves and hawks creates real uncertainty in bond markets. The 10-year Treasury yield currently sits at 4.67%, reflecting that anxious mood. The implied CPI expectation of 2.66% remains well above the Fed's 2% target, suggesting the inflation fight is far from over. For Canadian investors, a hawkish Federal Reserve tends to strengthen the US dollar, which can put downward pressure on the Canadian dollar and affect the competitiveness of Canadian exporters. It also influences how the Bank of Canada positions its own policy, given the interconnected nature of the two economies. In commodity markets, there was significant action today. Oil has dropped below $100 a barrel for the first time in several weeks, driven by progress on the Iran nuclear deal that increases the prospect of additional global supply. This is a genuinely mixed story for Canada. Lower oil prices reduce input costs across the economy, transportation, manufacturing, and agriculture all benefit. And gas price relief at the pump is welcome news for Canadian consumers heading into the summer driving season. However, energy stocks on the TSX felt the direct pressure from the decline. Companies like Enbridge, Suncor, and Canadian Natural Resources saw their shares move lower. That said, these companies have diversified pipeline networks, refining operations, and long-term infrastructure contracts that provide meaningful insulation from day-to-day crude price swings. Bank of America issued a notable warning that deserves attention. The bank's strategists are characterizing the current moment as a potential bull capitulation. When the last skeptics throw in the towel and pour into stocks, it often signals that the easy gains are behind us. There is data to support this concern. We have seen massive cash-to-stocks rotation over the past month, and sentiment surveys show bullish readings that historically have preceded short-term pullbacks. However, contrarian indicators like this are best used as awareness tools, not as sell signals. The legendary growth stock investor, Phil Fisher, would remind us that great companies held through periods of uncertainty and volatility generate the best long-term returns. He would encourage investors to focus on the quality of the businesses they own, their competitive advantages, their management teams, their reinvestment opportunities, rather than being swayed by short-term sentiment readings. Berkshire Hathaway's latest 13F portfolio filing captured significant attention today. Warren Buffett's firm revealed a new $2.6 billion position in Delta Air Lines, a clear bet on the continued recovery in air travel. Berkshire also increased its Alphabet position by a stunning 224%, nearly tripling down on the tech giant. Both moves suggest that the Oracle of Omaha sees substantial value in sectors that have been overlooked by the broader market. The everyday investor's champion, Peter Lynch, would recognize and endorse this playbook. His philosophy was simple and powerful: by what you understand, look for companies with a compelling story that the market is underestimating, and hold with conviction. Both Delta and Alphabet fit that framework, well-known businesses with strong underlying fundamentals trading at attractive valuations. On the AI sentiment front, OpenAI secured a major legal victory today, as a lawsuit filed by Elon Musk was dismissed by the court. This ruling removes a cloud of legal uncertainty over OpenAI's path to an eventual initial public offering. An OpenAI IPO would be one of the most anticipated stock market debuts in technology history, comparable to or even exceeding the Facebook and Alibaba listings in terms of investor frenzy. The positive resolution here boosts sentiment across the entire AI investment ecosystem. The disruptive innovation expert, Cathie Wood, would view this as clear validation of her core thesis, that artificial intelligence represents the defining technological transformation of our era. She looks for companies positioned at the leading edge of transformative change, and the entire AI supply chain, from chipmakers to software platforms to data center operators, fits squarely within that framework. Now let us turn to our stock picks for Canadian investors this evening. We have selected 4 names, each aligned with a different investment philosophy, so there is something suitable for every type of portfolio. First, a defensive anchor. Pfizer trades at approximately $26 per share, making it accessible while offering a meaningful dividend yield. The pharmaceutical giant has a deep pipeline of approved drugs and a strong balance sheet. Ben Graham would find this attractive: a well-established business with steady earnings, a reliable dividend, and a valuation that does not require speculative growth assumptions. It is the kind of holding that provides portfolio stability during uncertain market conditions. Second, a balanced growth opportunity. Cisco Systems trades around $99 per share. As we discussed earlier, the company is a direct beneficiary of the AI networking infrastructure build-out. Data centers need exponentially more bandwidth, and Cisco is the dominant supplier of the switches, routers, and software that make those networks function. Phil Fisher would appreciate Cisco's strong competitive position, its consistent reinvestment in research and development, and the multi-year runway ahead as enterprises across every industry upgrade their infrastructure for the AI era. Third, a more aggressive pick for investors comfortable with higher volatility. Carnival Cruise Line shares trade at about $26. The summer cruise season is ramping up, booking volumes look strong, and critically, oil dropping below $100 significantly reduces Carnival's largest operating expense, fuel. He would recognize the turnaround narrative here: a familiar brand with improving financial fundamentals, a catalyst in lower costs, and a market that may not yet be pricing in the full recovery story. Fourth, an affordable option accessible to virtually any budget. Ford Motor Company trades at roughly $13 a share. The automaker offers a dividend at that price level. She would highlight Ford's strategic pivot toward electric vehicles and connected car technology as the kind of innovation that could fundamentally reshape the company's trajectory over the next decade. For investors just starting out, Ford provides exposure to both traditional automotive earnings and emerging EV growth. Let us close our analysis with a look at the TSX today. The Canadian market showed notable relative strength compared to its U.S. counterparts. Fairfax Financial Holdings, the Toronto-based insurance and investment firm, edged higher on the session. Canadian Pacific Kansas City surged more than 5%, reflecting optimism about rail freight demand as the economy stabilizes. BlackBerry, the Waterloo-based technology company, gained nearly 5% on no specific news, a potential sign that investors are revisiting the stock after years of neglect. Canadian energy infrastructure names like Enbridge, Suncor, and Canadian Natural Resources traded mixed as oil prices declined, with pipeline operators holding up better than pure producers. Real estate and financial stocks on the TSX also showed resilience. For Canadian investors, the overarching takeaway is that diversification across sectors, geographies, and investment styles remains the most reliable path to long-term wealth building. To summarize, this evening we saw nvidia deliver a knockout earnings report that confirms the AI investment cycle is accelerating. Kevin Warsh's arrival at the Fed introduces policy uncertainty that markets will need to navigate. Oil below 100 is a tailwind for consumers and transportation stocks. And the Berkshire portfolio filing reminds us that some of the world's best investors see opportunity in travel and tech. For your portfolio, remember that each stock pick serves a different purpose. He would recommend steady income in defensive names. He would look for quality growth at a reasonable price. He would bet on underappreciated turnarounds. And she would lean into disruptive innovation. Together, these approaches build a balanced foundation for any investor. This has been your Markets Closed recap for May 20th. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.